Hello, welcome back. I am temporarily using my MacBook's web camera till I get the new stack that I want to be able to record in a better fashion. But I wanted to make a video about Alibaba because it has been pretty much getting decimated lately. And so it's a good time to take a little bit of a fresh look and see what is going on with the overall market and Alibaba as well. Now, the first thing that we want to be taking a look at is obviously the earnings report. And I do have it here. And the earnings report was actually fairly solid. So it's actually really good compared to what the company was doing in the previous quarters, understandably so. And we kind of expected that because, in the past few quarters, during what was happening with the pandemic and everything, most companies have suffered. And Alibaba was one of those as well. But as you'll see here, for instance, the company had a revenue that surged 60%, for instance, year on year, which is tremendous, frankly. And if you take a look at the revenue and the net income, you will see that the revenue that the company did was actually significantly more than expected too. 234 billion won versus 222 that was expected, 225, sorry, which is up 14% year on year. And if you remember the discounted cash flow models that we were, generally speaking, doing in the previous videos that I was creating for Alibaba, I was using significantly lower values. Now, this is obviously the quarter, but still, I was using like 6%, 7%, sometimes even lower. So 14% for the quarter, pretty nice to see. Now, the net income also from 34.3 that actually happened versus the 28.66 that was expected, up 51% year on year. So pretty fantastic here for Alibaba and nice to see. Now, the thing is, stocks have been sinking as China was a global sell-off, pretty much, sparked global sell-off. And today we had the same thing. That's yesterday's news, and today we also had a decline, an overall decline in the stock market. So we do expect this potentially for maybe a few more sessions, as the overall market has turned a little bit bearish, and it kind of happens during summer, especially. You may have heard of the old saying that you should be selling during summer and then come back during winter is what they're saying for the stock market sometimes. And most situations, most cases, it actually turns out to be correct. Not always, but this time definitely so. And another thing that I want to take a look at, and I think it's useful to know, is what is happening with the large investors, well-known investors like Michael Berry, who actually sold his position. He got out of Alibaba completely. And as you'll see, he sold out of 100,000 shares in Alibaba, which is obviously not great to see, as this was almost 10% of his portfolio, and he got rid of it. Looks like he's turning too bearish right now. And, I don't know if he knows anything, but yeah, he's definitely turning completely bearish, not only for China, but the overall markets as well, as he sold, for instance, Zoom as well. And I think he sold JD.com too, right? JD.com. However, when somebody sells, somebody's buying, right? And the person who bought is actually George Soros. And George Soros buying is fairly interesting. Obviously a massive investor here. And the thing is, when we're talking about George Soros, some people actually would call him a puppeteer even. And if not a puppeteer, he's generally very well connected. So when George Soros does something, I definitely would listen. And Michael Berry too, frankly. And so they're getting a little bit in a contradictory position here from each other. And George Soros, as you'll see here in this report, actually bought 175,000 shares of Alibaba, so almost double to what Berry actually sold, or he sold 100,000. And I have here his filings. I was interested to see what kind of previous trades he has taken regarding Alibaba. And the last one was actually selling back in 2018. That was a good time to sell, it looks like. And he sold back when it was almost 150. He got it back in Q3 2018, and he sold it a quarter later. Frankly, actually lost money here in this one. And now he bought it in Q2 2023, 175,000 shares. And in the past, he has traded Alibaba quite some, as you'll see. And interesting to see, it's a pretty large position here, probably the largest in the, when compared to the previous like 5 years or so, it's definitely the largest. So yeah, interesting to see all these things. It's good to know about all this, frankly. And so this is why I wanted to let you know. Now, of course, we also want to see what is going on with Alibaba, regardless of what is going on with the institutional or other types of investors. And today Alibaba was up, but in the past month, is what we're having here in this chart, you'll see that it's going down. So we have been having some negative sessions here overall. And today was a little bit of a positivity note after going down quite significantly. At some point over here, as you'll see, that was August 10th, that was last week. It was near 100. So it has gone down quite significantly, losing more than 10%, going back down to 90 almost. And the P ratio of the company sitting at near 20, and at some point it was higher because remember, Alibaba's net income has gone down during the pandemic. I think that we talked about in multiple videos in the past. And as I told you back then, I was expecting it to rebound, and it sure does. It sure has rebounded actually. And now we're at a much, much healthier P ratio, near 20, and an even better price to free cash flow ratio, which I love to see. And it's going down and down and down. It's insane. Just looking at this, it's almost obvious that the company's valuation here compared to its stock price is really, really cheap. And the outstanding shares of the company also going down with a little bit of extra liabilities, but the company, generally speaking, doesn't have much debt, as you'll see here. Now, the thing that we want to be examining, of course, in our tool, you can examine all sorts of things here, but I do want to be taking a look at our discounted cash flow model. And now that I'm watching the camera, actually looking at the camera, and I can talk to you directly, you can see me. It's worth telling you a little bit about the discounted cash flow model and why I like it so much. Now, I will be making videos that I will be talking in detail about how discounted cash flow models work and how cash flow works and what it is and why it is important. But the thing to understand is when you are looking at a company, the companies that you are buying should be generating cash flow. If they are not generating cash flow, what are they worth to you? Now, what is a company worth if it's not making any money? Is it worth $10, $100, $100 million? It's tough to say. When you're buying such companies, you are mostly buying them on the premise that they could potentially do well in the future, which means that you are already overpaying because they're not doing well currently. And so what we're doing with the discounted cash flow model is, and this is a 5-year discounted cash flow model here, for instance, in our tool. What we are doing is we're basically thinking that the company will generate a specific amount of money in the next 5 years. And so we actually sum these amounts and we discount them for today. What does that mean? We're discounting the cash flows is important because money that the company makes today is worth more than money that the same company makes 10 years from now. Why? Because of inflation, right? So money loses value. And so $100,000 today is much more valuable than $100,000 10 years from now. And this is why we have to discount that. We have to have a factor of discount over there so that we calculate a fair amount for the cash flow. And we don't really look at the company that is making $10 million today and $10 million 10 years from now the same way. And so you can understand why growth is important and why high growth is important. If a company basically does 10 million now and 10 million 10 years from now, it's really bad. It's not only not growing, it's actually going downwards because it's losing money effectively due to inflation and the effect of money losing value over time. And so what we want to be having is companies that grow through the years, at least actually about the inflation rate, if not more. Actually, we do want more, obviously, the more the merrier, but we definitely want to surpass inflation. And so what we're doing here is what we're examining with our model here. And we have the handy little tool here that tells us what the company has been doing in the past few years, like 5 years. And this is super, super handy because it gives us the averages, it tells us exactly what was happening every year. And we know that, for instance, the company has been growing its revenues at a tremendous pace over here, apart from last year. But overall, they have been growing their net income, that is basically their sales, pretty much, their revenue, through a very healthy pace. And so also the same thing with the net income and the same thing with the free cash flows, again, growing through the years. And with some years being negative, of course, yes. We do know that, and it has obviously been affected by the pandemic as well. Now, the revenue growth that we're going to be using for our projections, and we do have low, medium, and high estimates. And the reason why we're doing that is we have different scenarios that could play out, like what happens if the company grows 3%, 5%, 7%. And so we actually calculate these scenarios, and the tool will tell us whether the stock is actually a buy today based on the cash flows, based on the actual amount of cash that it generates for the next 5 years, that it will be generating for the next 5 years. And so we will have a very specific and handy way to evaluate the company, and not just, the fact that the company could be doing well or bad, or that there is a negative or positive sentiment in the markets, because all these things are temporary and can change through the years or through the weeks, frankly. And we're going to be using relatively low values, even though if you look at different analysts, you could be having even higher projections. So I'm going to go like 5%, 7%, and 9% for the potential revenue growth in these scenarios, with 9% obviously being the highest projection, the potentially highest one. And the net income margins, let me actually move over here, move myself. The net income margin that I'm going to be using, again, you can kind of see the averages. Now, the company typically does something like 17%. You will see that's the 5-year average. The 3-year average has been affected by what has been happening in the past couple of years, right? Understandably so. And last year also wasn't great. But we don't want to go that low, and we don't want to go potentially that high as well. You could do that, getting access to the tool. All our patrons have access, by the way, at myinvestorshaven.com. You can find the link in the description box below this video if you're interested in becoming one and gain full access. But I'm going to be using something that is relatively lower, and I could even go 17 everywhere here, or 16 everywhere, or 15 everywhere. I can do whatever I like here in terms of the projections that I want to be making, but I will go 15, 16, and 17, which is more conservative and will give me lower values already. I do know that because it's lower than the expected one and what the company has been averaging. And the free cash flow margins that I'm going to be using have been a little bit all over the place because the company has lost a lot of net income in some years, but overall it tends to be around 100%, the typical one, like 90, 100, 115, 125. We're going to go somewhere in between, and I typically like to use something that is very conservative, something like 80%, 90, and 100 here, and an annual return of 13%. You may be asking why I'm using 13%, and again, it's a good opportunity to talk to you directly and tell you why. Now, if you think about an index fund, for instance, like the S&P 500 index fund, it makes about 10% a year. So if you buy it today, you're going to be making 10% every year. That's excluding inflation. And so this means that you are buying an index fund, which is, generally speaking, I would say the base investment, like the relatively risk-free investment, which I tend to use in my 401, my pension, basically. And the thing that is important to notice here is that an index fund is not risk-free, but lower risk investment. And so if we're investing in a single company, as Alibaba is, or Google, Facebook, whatever, we have more risk because it's a single company, and a single company can always go wrong, can default, things can happen. Yeah, it has more risk, but it has potentially more gains to come as well. So there is a little bit of a trade-off there. And if you have more years ahead of you, for instance, it makes sense to invest in some of these great companies, because you're not just investing in the stock market, you are investing in an actual business, is the difference here. When you're buying the index fund, you're basically investing in the overall market or an industry, which makes a ton of sense in regards to risk, but it's a little bit of a different story. And again, it's nice to have in a pension fund, but not really if you want to grow in a more serious manner, I would say, or if you really want to be investing in actual companies and what they're doing through the years. And if you buy them at cheap prices, even you can make some good money, as we did, for instance, with Meta. And so this is why I'm using 13%. It's more than 10%, and I think it makes sense. You could use 11%, 12%. It's a little bit of your selection there. You could even want more, like 15%. And as I've told you in the past, if a company is more risky, then it makes sense to ask for more, for a higher annual return, like 15%. It would make sense. So that if you are potentially willing to trade companies like NEO, for instance, which is a risky company, risky business as it is right now, you could ask for an annual return of 15%. But over here, 13% makes a ton of sense. And this is what I'm going to be using. And I'm going to hit calculate and see what we're getting out of our tool here in regards to BABA. And I'm going to move again just to see what came out. And you will see that the max price to pay for low, medium, and high is 97, 127, and 163, with the current price of Alibaba being at $91.4, basically telling us that the stock is very, very cheap right now. And even with very conservative, frankly, projections there and estimates for the next 5 years, it's easy to see that everything is green in regards to free cash flow. And so, for me, Alibaba is 100% a buy here. However, there is always the risky sentiment, there is the negative sentiment and the potential risk that we have from China. It could potentially go on for a while, but I don't really pay too much attention to what is happening with politics and I guess temporary fluctuations in the market. I don't really care so much about that. I do care about what the company generates in regards to their business. That's my only concern. So this is what I think about Alibaba. I'd love to know your opinions, guys. So leave a comment below. Let me know what you think about the company. And if you are new around here, remember to subscribe as well. And like the video, that helps a ton. Thanks for watching. I'll see you soon. Bye-bye.